There will be a financial crisis actually worse than the one in 2008, and you say things like that, people say you're exaggerating or you're fear-mongering. No, there's good analysis behind it, but I go all the way back to 1987, October 19th, 1987, the U.S. stock market crashed 22% in one day. Dot-com collapse, NASDAQ goes down 80%. 2007 mortgages, 2008, the global financial crisis. These things happen every 5, 6, 7 years with some regularity. Now, it's now been 11 years since the last one. It doesn't mean we have a collapse tomorrow, but no one should be surprised if we do. So then the point I make, well, if it's coming, which it is, and if you can see it and kind of estimate the magnitude, and that's important because this will actually be worse than 2008. Well, you can actually look at the sequence, and I'll just go back to 1998, but what happened at the end of the day? Wall Street banded together and bailed out a hedge fund, long-term capital, and I negotiated that bailout, so I had a nice front row seat on that one. 2008, 10 years later, the central banks banded together and bailed out Wall Street. Who's going to bail out the central banks the next time? The point I make is that each crisis is bigger than the one before, and the bailout is done at a higher level than the one before. But we're now at the point where, in 98, Wall Street lifted the balance sheet of a hedge fund. 2008, the central banks lifted the balance sheet of Wall Street. Who's going to lift the balance sheet of the central banks? Who's bigger than the central banks? We're still in the aftermath of the 2008 financial crisis. I know we've had 10 years of growth and stocks are at an all-time high, I get that, but the damage was so severe and the remedy was so extreme, they've never been able to normalize, get their balance sheets and interest rates back to normal. We're just not ready for the next one. The evidence shows that you need to cut interest rates 4 to 5% to get the U.S. out of a recession, kind of stimulate growth. In other words, how do you cut interest rates even 4% if you're only at 2%? The answer is you can't. So then you go to QE for quantitative easing, more money printing, and you get to zero. Let's do more money printing. But again, the Federal Reserve took its balance sheet from $800 billion to $4.5 trillion in the last crisis. They got it back down a little bit, around $3.9 trillion, but nowhere near even $2 trillion for that matter. So they're out of headroom in terms of quantitative easing. Rates aren't high enough to cut very much. So they don't have the dry powder, if you will, to get us out of another recession. And that's just a normal business cycle recession. That's not even talking about a financial panic, which is a different thing. So the damage done in 2008 has not been normalized. We're not ready for the next one. And if it happened, we don't have the capacity to get out of it. What are you waiting for? When it actually happens, it'll be too late to do anything about it. So stocks drop 30, 40%. Gold's going up $100 an ounce per day. Dealers won't return your phone calls. It's too late to sell your stocks. The time to prepare is not when you're in the storm, it's beforehand. If you absolutely knew that inflation was coming, that's the danger, it'd be very easy to construct your portfolio. You'd have some gold, you'd have some real estate, some hard assets, etc. If you knew it was going to be deflation, same thing. You could buy 10-year treasury notes, buy gilts, buy things that perform well in deflation. I call this the barbell approach. You have your inflation hedge over here, your deflation hedge over here, and then a allocation of cash connecting the two sides of the barbell. The point I make is that we're on the knife edge between deflation and inflation. The world wants to deflate. The natural state of the world is deflationary because of demographics, declining populations in a lot of countries. So debt, demographics, and technology are driving deflation. On the other hand, you have central bank intervention. Central banks cannot tolerate deflation because it increases the real value of debt, causes bankruptcies which fall upon the banks. So they have to try to create inflation. So right now we have this unstable equilibrium, but it's going to tip one way or the other, and you need to be prepared for both, actually. When you're in my position, you're a writer or speaker or whatever, people always want to put words in your mouth, and they say, Jim Rickards says it's the end of the world, sell everything, buy gold. I've never said any of those things. It's not the end of the world. You should have some gold. I recommend 10%, but don't go all in on any asset class. Diversification is very, very powerful. But this could actually be a world where systems break down. It's not the end of civilization, but maybe slightly more agrarian. Maybe it looks more like 1910 than 2020, where we actually go back to a simpler lifestyle, not because everybody would vote for that or want that, but complex dynamic systems, when they break down, when infrastructure breaks down, if that sort of thing starts to happen. I mean, these things are a little too frequent for comfort, and don't think, I'm sure you know, that Beijing's quite concerned about Hong Kong, not only because of Hong Kong and their claim of some kind of autonomy, but if they have any success, that will start to break out in China itself, Wuhan, Xi'an, Chongqing. You'll start to see those kinds of things, and the communists know it. So they need to keep a lid on that. But these are all symptoms of societal breakdown. They're not specifically financial. They have financial implications. But yeah, you could see multiple complex dynamic systems, power grid, financial systems, communication systems, etc., sort of sequentially break down, and then we could be back to a much simpler lifestyle. My point is, this is how societies evolve and collapse. There's this notion, I think the left and progressives, but maybe a lot of conservatives as well, that things just get better and better and better. New technology, new medicine, better cures, society does get wealthier, etc., and that's how it goes. That is not how it goes. That is not what history says. History says it's much more cyclical. You have rise and fall of civilizations, multiple civilizations over thousands of years, and the two biggest collapses, there might have been a more ancient one, we don't have any information, but the Bronze Age collapse and the fall of the Roman Empire. These were at a 1,500-year tempo. It's been about 1,500 years since the fall of the Roman Empire, so if there is a 1,500-year multiple civilization collapse cycle, we could be in the middle of that. Someone asked me, when's the next crisis coming? I said, well, we may be in one. From 2008 to 2014, we had quantitative easing. Then there was a sideways period. Then beginning in 2017, the Fed initiated what they call quantitative tightening, actually reducing the money supply. I still run into people, they bang the table, I hate QE, you're printing money. I said, no, that's been over for about 5 years. They're now burning money, throwing money into the furnace to reduce the money supply. Except, just a few days ago, they slammed on the brakes on that and flipped to quantitative easing. The Fed is in the process, as we speak, of printing $1 trillion. They call it system repo, but it's QE4 in all but name. Why are they printing $1 trillion when they were trying to reduce the balance sheet? They were trying to tighten the money supply, and they're printing $1 trillion. Somebody's broke. I'm not going to mention names, I'm not going to speculate. They're giving the money to the banks, taking treasuries as collateral, but they expect the banks to lend the money to non-bank players, hedge funds, private equity funds, smaller banks, Chinese banks, etc., and take treasury securities as collateral. The way it works is, I give you $100 million, and you give me $102 million of treasury notes or gilts. And so I've got 2% collateral, so if you don't pay me back, I sell the notes in the market and pay myself back. What does this say when the banks are hoarding the money and they won't lend it out and take treasuries as collateral? What it says is that they're anticipating a liquidity crisis that's so bad that they will not be able to sell treasuries at anywhere near the value they got. That's a pretty scary thought. That means they're seeing something the rest of us are not seeing. Now, I won't go further than that because there's no evidence, but just what we know about reserves being drawn down, now suddenly increased, the bank's not on lending, etc. Someone's in distress. It could be contained, it could go away, but if it hits and spreads, we could be back in a global liquidity crisis, and it could be starting now.